Homeowners are now underwater and selling their homes at a loss, signaling that we may have just entered the housing crash we've all been waiting for. Let's get right into the data. Redfin is now reporting that 1 in 8 San Francisco homeowners is selling their home at a loss, losing an average of $100,000 per sale.
They're taking a $100,000 loss.
Yes, Nick Gurley of Reventure Consulting, that's correct. The percentage of San Francisco homeowners selling at a loss, 12.3%, is equivalent to the level we saw in 2008 when the last housing bubble finally came crashing down. And San Francisco is not the only U.S. metro with homeowners taking on a loss to offload the homes they can no longer afford. Redfin reports that Detroit, Chicago, New York, and Cleveland round out the top 5 cities where homeowners are selling in the red, posting double and triple digit losses at median per sale. Though, looking at this next column, we see the median capital gain in each of these cities is positive. San Francisco is showing a median capital gain per sale of $625,500. That's a little confusing, so let's break down what we're looking at here. In San Francisco, 12.3% of sellers sold at a loss. So they lost between $1 and who knows what on the sale, but the median for this group, for sellers who sold at a loss, was negative $100,000. So we can even go a step further and say that 6.15% of sellers lost between $1 and $100,000, and the very bottom 6.15% lost between $100,000 and who knows how many dollars. Now, the median capital gain across all sales was $625,500. So that means that 37.7% of sellers made between $0 and $625,500 when they sold. And then above that, fully 50% of sellers made more than $625,500 when they sold. What's the upper end of this spread? What's the 99th percentile of home sale capital gains in San Francisco? Well, Redfin isn't saying, but as an example, this home in the San Francisco suburb of Menlo Park was recently sold for $8.2 million by a homeowner who bought it in 2012 for $4.8 million. That's a capital gain of roughly $2.75 million when you account for transactions costs. So you can see this upper boundary is probably quite high. All right, so why is this happening? It's a story we can tell pretty cleanly just based on what we understand of the last few years. Tech stocks exploded during the pandemic lockdowns. The NASDAQ literally doubled, and tech richies went hog wild paying handsome sums for luxury homes throughout the Bay Area. By the beginning of this year, however, NASDAQ saw a massive 50% sell-off. Tech layoffs were the new trend, valuations dropped, VC funding dried up, startup adjacent banks collapsed, and we started hearing that downtown San Francisco had become a cross between Grand Theft Auto and The Walking Dead. It's a local story, and we know it's a local story because the San Francisco numbers have deviated from the national numbers. While San Francisco's percentage of underwater home sellers is at 12.3%, the national average is just 3%, which is the lowest point on this graph dating all the way back to 2000, with the exception of 2022's historic pricing peak. In contrast, during the last housing crash, underwater sales in San Francisco tracked along identically to national numbers. That housing crash and the underwater sales that went with it were a national story, a national phenomenon that affected almost every market coast to coast. If you've enjoyed this video so far, please click that like button. It really helps push this video out to more viewers and grow our channel. I appreciate it. Austin, Texas is another local story. With 3% of its sellers being underwater, it's right at the national average. But we know something unique is happening in Austin because of how much this percentage has grown over the last year. Whereas the percentage of underwater home sellers grew by 50% nationally over the last year, Austin saw a 1,400% growth in the same metric, from just 0.2% of home sellers selling at a loss to now 3%. So by raw numbers, Austin is performing at the national level and no worse. But by looking at the rate of change for this metric, in other words, looking at its momentum, we see that Austin is plummeting, is in free fall compared to the rest of the nation. And again, the story here is in plain daylight. Austin was flooded by tech workers from relatively more expensive coastal cities like San Francisco, Seattle, Portland, Los Angeles, even New York. Demand surged while supply remained tight, so prices ballooned. Now, many of those same workers are being called back to the coasts, not to mention, as we mentioned earlier, the tech sector has been contracting generally over the last year. And voila, an explosion in underwater sales from an anemic and impressively low level, I mean hardly any, up to the national norm. So when you're considering your home purchase or your next real estate investment, and even if you're just camped out on YouTube watching videos about the real estate market, you have to distinguish between national trends and local stories. Because while we're talking about single-digit percentages of underwater sellers, with only San Francisco entering double-digit territory at 12.3%, let's remind ourselves what a national trend looks like. From 2005 to 2007, while home prices were still climbing, the percentage of underwater home sellers rose from 5% to 10%. Let's just appreciate this for a second. Over a period of time during which the median US home price grew 16%, the percentage of underwater sellers doubled. It's really difficult to overstate how different the 2005 to 2007 run-up was compared to the 2021-2022 run-up, but I hope that statistic at least gives you some perspective. Over the next 2 years, as the bottom fell out, the percentage of underwater home sellers exploded from 10% to 65%, and then remained above 50% for the next 4 years straight. Even in 2017, 2018, 2019, when home prices were on the rise again, and most markets were sellers' markets, the percentage of underwater home sellers was between 10 and 20%. Here's my favorite example of how localized market trends have become since last year's run-up in pricing ended. And this time, I'm using maps produced by HousingAlerts.com, a fantastic source of real estate data and analysis. We're looking at year-over-year appreciation for Washington state. Right now, we're currently at negative 0.9% appreciation. But last year at this time, Washington state was enjoying 22.1% year-over-year appreciation. Let's drill down to the metro level. We see that every metro in Washington, including the Portland-Vancouver metro, which straddles Washington and Oregon, and the Lewiston metro, which straddles Washington and Idaho, they all posted appreciation numbers from the high teens to the mid-20s. They're all in line with the statewide appreciation rate of 22.1%. The biggest underperformer is Longview, and with 16% year-over-year appreciation, it lags the statewide metric by about 27%. The big overachiever is Spokane, performing about 12% better than the statewide number. Not a lot of variance from metro to metro. What we're seeing is a widespread trend. Now let's look at this year. Again, statewide, Washington is seeing negative 0.9% appreciation. In other words, Washington has been basically flat for the year. But when we drill down to the individual markets, we see much more variation. Seattle is actually down 3.1%, fully 3 times the statewide trend. Bremerton's down 4.3%. Meanwhile, Yakima's up 4.6% and Lewiston's up 7%. That represents an 878% variance from the statewide trend. See how fractured Washington's metros are now compared to last year? We're not seeing a widespread trend, but specific metros moving in opposing directions. The picture gets even more interesting when we look at foreclosures, which we'll do next week. Subscribe and hit the bell icon so you don't miss it.